In March 2023, Porter Davis Homes, Australia's 12th largest builder, collapsed overnight, leaving 1,700 homes half-built and 779 families with signed contracts but nothing to show for it. Within 18 months, 3,217 more construction companies followed. That's 8 companies collapsing every single day. But here's what should terrify every Australian planning to build. In March 2025, Roberts Co., owned by a multiplex heir who took over failed projects trying to save the industry, collapsed with losses exceeding $60 million. Even billionaires with unlimited resources couldn't make the math work. By the end of this video, I'll show you exactly why Australia's construction industry is in a death spiral and why the government schemes that created this disaster are still running today. Let me show you the scale of this catastrophe. According to ASIC data, here's what's happened to Australia's construction industry. 2022, 1,793 construction firms collapsed. 2023, 2,546 firms collapsed, a 42% increase in 1 year. 2024, 3,217 firms collapsed, another 26% increase. First 3 quarters of 2025, already up 24% compared to last year. In the 12 months to March 2025 alone, 2,636 construction companies became insolvent for the first time. That's not companies struggling, that's companies dead. Between May 2023 and May 2025, just 24 months, well over 5,000 construction companies have collapsed across Australia. Construction now accounts for 27% of all company failures nationally. That's an unprecedented share for a single industry. Veteran builder Scott Challen told reporters, "We will see another 1,000 companies collapse in the next 12 months with all the associated suppliers and input businesses that feed into those companies. We're heading into the abyss. This is going to be bad." But before I reveal why this is happening, let me introduce you to a homeowner who's living this nightmare right now. This is what happens when your builder collapses mid-construction. Imagine this. You've saved for years. You've signed a contract. You've paid your deposit, sometimes $100,000 or more. Construction begins. Walls go up. The frame is completed. You can see your dream home taking shape. Then one morning you get a call. Your builder has entered voluntary administration. Construction stops. Immediately, workers abandon the site. Your half-built home sits exposed to weather. No roof, no windows, just a concrete slab and timber frame slowly deteriorating. You try to find another builder to finish, but here's the nightmare. Every quote comes in 30 to 40% higher than your original contract. Why? Because costs have exploded since you signed. Timber up 40%, steel up 35%, labor costs through the roof. Your domestic building insurance? It won't pay out for 5 weeks after insolvency. And even then, policy limits vary by state, sometimes capped at just 20% of the build value. In Porter Davis's case, they hadn't even taken out the insurance, leaving 1,700 families completely in the lurch. RSM restructuring partner Richard Stone worked on multiple collapsed builders. He explained, Porter Davis, Langford Jones Homes and Probuild followed similar patterns. Large volumes of incomplete projects, funding gaps, and limited protection for consumers. Each collapse left hundreds, sometimes thousands of homeowners stranded mid-build, with deposits paid and construction halted. So what exactly is killing these builders? The answer is a toxic combination that's been building since COVID. Here's the financial trap that's destroying builders. During COVID, 2020 to 2022, the Australian government introduced the HomeBuilder stimulus program. It offered first home buyers up to $25,000 grants to build new homes. The goal? Stimulate the construction industry during the pandemic. Demand exploded. Building companies with large sales teams signed 3, 4, maybe even 5 times the normal number of contracts in a single year. Association of Professional Builders co-founder Russ Stevens explained, "The problem is the big building companies all signed up way more contracts than they'd normally sign in a year. That came off the back of the COVID boom. But here's the killer. All those contracts were fixed price. Fixed price contracts lock in the cost before construction begins. You sign a contract in mid-2020 to build a home for $450,000. The project doesn't start for 12 to 18 months. By the time construction begins in 2022, costs have changed. Kibbe Insurance's head of underwriting, Matthew Boone, revealed, "We've observed large volume builders with substantial pipelines of fixed price and fixed term projects now facing costs 30% to 40% higher than initially quoted 2 years ago. This is untenable with average margins of 10% or less. Here's the math. You sign a contract to build for $450,000. Your expected profit margin? Maybe $45,000. By the time you start building, material costs are up 40%, labor costs are up 25%. Your actual cost? $540,000. You're now losing $90,000 on a job you're legally obligated to complete. Multiply that across 50, 100, or 500 contracts, and you understand understand why Porter Davis, St. Hilliers, Project Coordination, Lloyd Group, and Roberts Co. couldn't survive. They were legally forced to complete contracts at losses exceeding their entire profit margins. But the fixed price trap is only part of the story. There are 3 other factors accelerating this collapse. 4 factors converged to create the worst crisis in construction history. Factor 1. Material cost explosions. Construction materials that were readily available before the pandemic became difficult to source. When found, they came with long lead times and eye-watering price tags. Timber prices surged 40%, steel prices up 35%. Even basic supplies like insulation and plasterboard became scarce and expensive. Supply chain disruptions meant even if you could get materials, delivery delays pushed project timelines out by months. Every month of delay, more holding costs, more interest payments, more losses. Factor 2. Labour shortages. Australia's construction workforce was decimated by border closures during COVID. International workers disappeared. Skilled tradespeople became scarce. According to industry estimates, there are only enough qualified and unemployed construction workers to fill about 50% of vacant positions. What happens when demand for labour exceeds supply? Wages explode. Subcontractor costs went through the roof. Builders who'd locked in fixed-price contracts suddenly faced labour bills 25% higher than projected. Factor 3. Cash flow strangleholds. Construction contracts typically allow payments in arrears. That means contractors front the cost of labour and materials and wait 60 to 90 days for payment. Delays or disputes from just one project can have a devastating impact on cash flow. Worrell's insolvency practitioners explained, it is not uncommon for subcontractors to wait 60 to 90 days for payments, all in an environment where staff wages, supplier accounts, and general overheads all need to be paid. Delays from just one construction project can escalate and devastate cash flow. Factor 4. The domino effect. When one major builder collapses, it takes dozens or hundreds of subcontractors with it. Porter Davis's collapse exposed over 1,500 creditors. Project Coordination's collapse left 200 creditors exposed. Roberts Co. abandoned 8 major projects, including Australia's largest Amazon warehouse. Small family-run subcontractors who'd invested materials, labour and time suddenly became unsecured creditors. Many received nothing, and when subcontractors go under, it triggers more builder collapses. It's a vicious cycle, but here's the part that should enrage every Australian. Even with billionaire backing, projects still failed. In March 2025, the construction industry's saviour collapsed. When Probuild collapsed in 2022, Roberts Co., owned by multiplex heir Andrew Roberts, stepped in to rescue multiple failed projects. Roberts had unlimited personal wealth. He took over 6 major contracts, including Golden Age Group's 130 Little Collins Street development. For 2 years, Roberts poured his personal fortune into completing Probuild's troubled Victorian projects. He absorbed cost overruns. He dealt with subcontractor insolvencies. He tried to make the math work. In March 2025, Roberts Co. collapsed. Total losses? Over $60 million. The Craigieburn Amazon project alone lost $56.1 million. According to industry reports, material cost increases and subcontractor insolvencies made projects unsustainable. Roberts stopped funding the mounting losses from his personal fortune. A billionaire with unlimited resources, trying to complete projects he didn't originally sign, still couldn't make it work. That's how broken the economics are. So who else has gone down? And why isn't the government doing anything about it? These aren't small companies. These are industry giants with decades of experience. Probuild 2022, commercial construction giant, $250 million in debts, 18 ongoing projects abandoned. Porter Davis Homes, March 2023, Australia's 12th largest builder, 1,700 homes in progress, 779 contracts signed for homes not yet started, over 1,500 creditors exposed. Lloyd Group 2023, Melbourne-founded firm specialising in government infrastructure, 59 ongoing projects worth over $350 million affected. St. Hilliers, February 2024, despite $32 million cash injection, entered administration. 21 active construction sites immediately paused. Project Coordination, April 2024, Canberra builder with over 50 years experience, owed over $25 million. 16 projects on hold, including major government jobs. 200 plus creditors affected. Ian Cubitt's Granny Flats, 2024, experts in age-friendly housing for 30 years. More than 120 projects frozen midway across NSW and ACT. Roberts Co., March 2025. Victorian Arm collapsed despite billionaire backing. 8 major projects abandoned. Losses exceeded $60 million. These weren't fly-by-night operators. These were established companies with 30, 50, even 70 years of experience. Family-owned firms, industry leaders, all destroyed by the same broken system. But here's the twisted irony. The government program that created this crisis is still running. While builders collapse, the government doubles down on the same policies. John Winter, head of the Australian Restructuring, Insolvency and Turnaround Association, didn't hold back. "We took that strong run in the construction sector during COVID and then completely overjuiced it with stimulus for first home builders. The HomeBuilder scheme pumped billions into construction demand without increasing supply capacity. The result? A massive backlog of fixed-price contracts signed between 2020 to 2022 that builders must now deliver, even though costs are 30 to 40% higher." Helen Bird, corporate governance expert at Swinburne University, told reporters, "Legislation could be adjusted to give greater flexibility in how prices are set for longer-term projects, with the inclusion of a buffer. But has the government changed the rules? No. Fixed-price contracts remain the norm. Consumer protection laws are heavily skewed toward customers, protecting them from builder collapses, but giving builders zero flexibility when costs explode. The regulatory framework treats builders like they're the problem when the system itself is broken. Meanwhile, master builders' forecasts predict 1.03 million homes will be built in the 5 years from July 2024, a shortfall of 166,000 below the government's 1.2 million target. Why? Because builders keep collapsing. So what happens next? Where does this crisis lead? According to industry experts, here's what's coming. Scenario 1. Continued carnage through 2025 to 2026. Veteran builder Scott Challen predicts another 1,000 companies will collapse in the next 12 months. As each collapse triggers subcontractor failures, the domino effect accelerates. Fewer builders means less competition. Housing supply drops even further. Costs continue rising. The crisis deepens. Scenario 2. Legislative reform. The government finally acknowledges the system is broken. They introduce flexibility for long-term fixed-price contracts. They allow cost variation clauses for supply chain disruptions. They reform consumer protection laws to balance buyer and builder interests. The bleeding slows. Scenario 3. Industry consolidation. Small and mid-sized builders disappear entirely. Only massive construction companies with deep capital reserves survive. Housing becomes dominated by a handful of corporate builders with less competition and higher prices. Consumers lose choice. Costs skyrocket further. Industry analysts believe Scenario 1 is most likely through 2025. The 2022 Reserve Bank of Australia review predicted exactly what's happened. They warned insolvency levels would increase. They were ignored. QBE Insurance predicts a 5% decline in both residential and non-residential building work for fiscal year 2025. That's not stagnation, that's contraction while Australia desperately needs more homes. Here's what homeowners need to know about protection. Unlike other major investments, superannuation, banking deposits, payments to professional services, the construction sector has minimal regulation regarding how consumer funds are protected. If you pay a lawyer, your funds sit in a client trust account. If you deposit money in a bank, it's protected by government guarantees. But if you pay a builder $100,000 as a deposit, that money goes straight into their operating account to pay for other projects. Domestic building insurance exists in theory, but it has critical gaps. Claims cannot be initiated until 5 weeks after insolvency. Policy limits vary between states, sometimes capped at just 20% of build value. In Porter Davis's case, the insurance wasn't taken out at all. UNSW researchers found embarking on building or renovating a home is one of the largest investments an Australian will make. Unlike other large investments, the construction sector has little regulation regarding how consumer funds are utilised and protected. When your builder collapses, you join the unsecured creditors list alongside subcontractors. You're competing for scraps from a company with no assets left. In just 24 months, over 5,000 construction companies have collapsed across Australia. 2024 saw 3,217 closures, 8 companies collapsing every single day. The first 3 quarters of 2025 are already up 24% compared to last year. The cause? A toxic perfect storm. Fixed price contracts signed during COVID stimulus boom. Material costs up 30 to 40% after contracts were locked in. Labour shortages driving wage inflation. 60 to 90-day payment terms strangling cash flow. Government stimulus that completely overjuiced demand without increasing capacity. Even billionaire-backed companies like Roberts Co. with unlimited personal wealth, collapsed with $60 million in losses. If someone with infinite resources can't make the math work, what chance do ordinary builders have? Meanwhile, 1,700 Porter Davis homes sit half-built. Families have lost deposits exceeding $100,000. Subcontractors, small family businesses, have been destroyed as unsecured creditors receiving nothing. And the government response? Nothing. Fixed-price contracts remain mandatory. Consumer protection laws remain skewed. The home builder-style stimulus that created this mess? Similar schemes continue. Veteran builder Scott Challen's warning is clear. We're heading into the abyss. This is going to be bad. I'll be tracking Australia's construction collapse every week, the insolvency data, government responses, and which builders are next to fall. Subscribe so you don't miss the next video where I'll reveal how to protect yourself if you're planning to build, and which states have the worst builder failure rates. Over 5,000 builders collapsed in 24 months. 8 companies failing every day. Even billionaires can't make projects profitable, and the government schemes that caused this crisis are still running. The question isn't whether more builders will collapse. The question is, how many thousands more will fail before the system gets fixed? Thanks for watching.